Welcome to the Peters McGregor webcast. I'm your host, Head of Research, Nathan Bell. I am joined by our Senior Portfolio Manager, Michael Haddad.
Hi everyone.
Michael's getting off fairly easy with today's formal presentation, so please save up your toughest questions for the end of the presentation for him. And we're also joined by our marketing department, including Matthew T and Alex. And Matthew will be helping me as technical advisor today for anything that involves anything more than hitting the down arrow on the keyboard. The title of today's presentation is Value's Time to Shine. We'll make that very clear coming up in a couple of slides. Before we get there, just the disclaimer, as always, please make your own investment decisions, and we'll take that as read. So I just want to read a quote here from Benjamin Graham, and this quote is nearly 60 or 70 years old. And it's, "The stock market was invented to move money from the impatient to those who are patient." And the interesting thing about the stock market is new generations of people come through and industries change. There's, in our probably seems like to us anyway, a lot more technology is used today than there ever has been before, but it probably felt like that way to a lot of people 70 years ago. But despite all the changes, and I think what is an increasingly short-term view in markets, one thing hasn't changed, and that's what Benjamin Graham has summed up here perfectly. I think when we're looking at our returns, and everyone wants their returns today, and it's very hard to have a long-term outlook when people are focused on big macroeconomic issues, negative media, and essentially people saying that this has been the most hated bull market of all time. It's important to actually sit back and look at the forest for the trees and work out what it is we're actually trying to do. And what we're trying to do is find the sort of companies that are going to provide a good return over time, where we have enough confidence in that business that we can sleep easily at night. And all that comes about is by paying the right price. And I think that's what's hardest for investors at the moment. Everyone's trying to find a decent return, but in doing that, they're forcing up the prices of the things they understand. So whether it's a company with a large growth profile or just a business with entrenched competitive advantages, all the companies we'd love to own, we don't necessarily have a chance to own them at the right price right now. So I come back to this quote from Benjamin Graham, which sums up to me what the stock market is all about. And despite all the changes, this quote hasn't changed in 70 years and is just as applicable today as it was back in the 30s and 40s. So you can see here there's a number of companies that we visited recently in North America. This is just a teaser slide. We're going to come back to this at the end of the formal presentation, and Michael and I will provide a few key takeaways from that. And the big question that people are asking at the moment is, how can you actually make money in the current environment, particularly in the US, where you've got valuations that are very rich? Other people have come to me and said, well, why aren't you investing more in Europe? It looks much cheaper. But if you have a look at the high quality businesses in Europe, they are just as highly priced as what the US companies are. Anything that has very reliable growth or is just a well-known company, so a lot of makeup companies, for example, a lot of healthcare companies in Europe trading on well over 20 times, if not 30 times earnings. So this is really an environment where we expect active value managers to prove their worth over the next 5 to 10 years in a way they haven't been able to distinguish themselves against a rampant momentum market over the past 4 to 5 years, at least since 2011. So at the moment, there's a handful of mega cap growth stocks that are carrying the market. And there's the FANG stocks, so Facebook, Amazon, Netflix and Google. It's now known as Alphabet. It looks like last year in particular, it looked like it was a really, really bad year for active managers, and particularly for a lot of famous ones, it really was. A lot of portfolios were down near 20%. Now, what was interesting about that is you've seen a lot of active managers struggling to keep up with the index over recent years, and it looks like the market as a whole has been doing really, really well. But in actual fact, what it's really been is just a few dominant, very large companies that are sucking up a lot of passive ETF money that have really shone. And it's been a situation where you're actually best to ignore valuations, which is something we never do, and just invest in what's going up. Now, our view is that's going to change, and we're already starting to see that. We're just coming to the end, or maybe we've come to the end of the second longest stretch that growth has ever outperformed value. 87% of time during history, value has outperformed growth. and we had a nice chart for this in one of our other packs. Has been a really rare occasion that growth has outperformed value for this long a period, but we're starting to see that change now. And the third point we've got there is just in terms of the macroeconomic outlook, we don't think we're going to see much higher US interest rates. It's always comical to me that at university we were always told that when the interest rates change, or the central bank changes interest rates, you wondered it would be 12 months before you would see the change ripple through the economy. And yet today you've got central banks actually looking to the daily movements of the stock market to inform their policy decision making. So it shows you how the environment has changed dramatically in a fairly short period. And also just on the home front, particularly personally, we expect to see lower interest rates in Australia. The last leg of growth in our economy has really been construction, particularly residential construction, and people investing in properties. So there's a big reliance on taking on more debt and capital gains in the residential investment market. That's not going to go on forever. We don't know how this is going to resolve itself or how long it will take. But particularly my view is that Australia will find itself at some point in a situation that will be not really much different to Europe and the US 7 years ago, where once people lose the expectation of capital gains on those investment properties, that will have a stifling effect on the economy, whether that's through construction, people losing their jobs in that particular sector, or just less investment. And the only recourse that a central bank has is that they can lower interest rates. There's really not a lot else they can do. And I expect they'll fully follow the same playbook in Australia that the central banks have elsewhere in the Western world. So how do we actually take this environment and actually turn it into a positive? The first thing we need to do is make volatility your friend. We've been through a period which is actually quite ironic, I think, given the negative headlines, that since 2011, when Europe looked like it was going to fracture, the US market in particular has just gone straight up. I know the market for Australia looks quite different due to its commodities and resources exposure, but we've really had very little volatility up until August last year and then earlier this year in January and February. So a lot of people get very scared about the volatility. That's the feedback we're getting from a lot of people investing these days. But you've really got, for us in particular, volatility is actually what we like. What we want is more opportunities to buy low and sell high. And one of the changes that may come from that as volatility increases, as people start to question the valuations of stocks, is that we may need to act a little bit more quickly and we may need to trade more often. So that's not discarding the value framework or the philosophy of what we do. It just means there's more opportunities that we're going to have to work quickly to buy low and sell high. And if we can do that over a long period, then our returns should look pretty good over time. And in terms of any sort of macro Australia versus US for us, we're unhedged. Our currency is still unhedged. We're still fearful of the medium term of what the Australian economy has got in store for us. At the moment, at least, Australia is still a yield play, and the Australian economy has held up pretty well, all things considered, given how commodity prices have come off. But just to reiterate, we are even more reliant on increasing property prices than we have been in the past. And I always tend to think of markets and economies as a rubber band, and it's human nature to stretch that rubber band and push things as far as we can go until they break. So the idea of whether it's growth in China or property in Australia, I don't think we're going to necessarily have a soft landing in any of these things. It might be a long time before they get resolved, but these things tend to snap rather than have soft, nice, cushioned endings. Mike, have you got anything to add on any of those points?
No, look, I would just emphasise that we are in a very richly valued, broad market environment. We're taking cover, as we always have, through staying focused on our core discipline of trying to identify great businesses with great management and construct a portfolio of a number of these at a material discount to our assessed valuation, and being very strict on that valuation, ultimately exiting at full value. So we think that leaves us relatively well placed in this market environment.
And depending on how we go with time, we might even have a talk about the discount rates in our models. It's been something we've been talking a lot about internally lately, with interest rates being so low.
Sure. All right, we'll speak to the numbers here over time, but I'll also just add, please feel welcome to ask any questions through the presentation, and we'll collect those at the end and deal with those, but feel welcome at any stage to go ahead and ask. So in terms of our numbers over time, there are a few key messages here we'd like to get across. Well, one is that over the short to medium term, we're really glad that we've broadly been able to keep pace with what has been a very strong market these past years. So we are really focused on identifying great businesses, great management, as I said, at a material discount to value. We find opportunities at times in some fairly obscure situations, and some less obscure situations. Companies like eBay that we purchased in 2014. At the time, the market was very focused on fairly poor results out of the core eBay marketplaces business, and not really focusing on the wonderful attributes of PayPal as a major unit of eBay. These sorts of companies, these sorts of situations don't tend to be market leaders during the bull phase of a market. So we're really glad that through sticking to our discipline and identifying value on a security by security basis, and being really strict with our valuation, so purchasing at a material discount to assess value and exiting at full value, that process of rotating over time and arbitraging value within these good businesses has helped us to earn enough to broadly keep pace over that sort of short to medium term horizon. I will note that over time, our clients expect to see numbers that are somewhat different. So we've been on either side of the ledger by a reasonable margin over any short period of time, and that really is a function of not necessarily being in the hot stocks of the day, of being able to have some cash in the portfolio as a byproduct of our process, and also being concentrated into our best ideas. So those all feed into us being different, and that also feeds into our correlation. So if you look at the column at the very right there, our correlation over time has been relatively low. That's both with the market and also with our main competitors. So we're really glad with that result, and that has real benefit for clients who may blend us in a core satellite type approach in portfolio. Over the long term, over the 7 to 10 year sort of horizons, we're at around 4% annualized outperformance, and again, we're glad with that result over time. It doesn't help us for the future, so the future for the portfolio will be a function of ensuring that we own at all times high quality businesses that really meet our strict criteria, and that remain appropriately priced. So stocks at very attractive valuations, and if we're successful in doing that, notwithstanding being different over any short to medium term horizon, we believe we'll be able to have good long-term numbers. And just a final comment really in terms of where we're at in the markets more broadly. The past 10 years obviously has been a very interesting environment. We've done well over that time frame. The past 5 years, again, it's been a challenge to keep pace. We've broadly kept pace, but again, we're at a level in markets where the broad market, in our estimation, is priced to provide relatively low returns on a forward 10-year basis. On the other hand, we own a portfolio of what we consider to be high-quality businesses with great management teams trading at quite attractive levels. So we believe we've got a good chance of doing well in an absolute sense over the next 5 to 10 years, and we're quite enthusiastic about the prospects for what that may translate to in terms of relative performance up against a market that we believe is quite stretched.
Yeah, personally, I think one of the, obviously we're talking our own book here, but one of the riskiest things investors could do today is to be looking at index funds, particularly in the US. Warren Buffett says, what smart people do in the beginning, the fool does in the end. And in 2009, it was actually a very smart thing to do, was to buy an index fund or an ETF on the market. You would have almost tripled your money if you were lucky enough to pick the low point. So it's a very good time to invest. But if you were to do that now, with valuations being where they were, it's just, for me, it's just the complete opposite. We've had huge run-ups in momentum stocks. We've talked about the FANG stocks in particular, and just how a few stocks have carried the market. And so the idea, I mean, last year I think there was $357 billion that went into ETFs and other passive strategies alone. that's the Johnny-come-lately effect. And people who are investing in those strategies aren't paying attention to valuation, and it actually hasn't paid to worry too much about valuation since 2011 in particular, and also since 2009. You just needed to be in the market. But we've been through that period, and that's what's now changing, and valuation is going to become a lot more important from here on, and that should start showing up in our figures over particularly the next 5 years.
Mm-hmm.
So we'll talk about a few changes first to the portfolio, and then a couple of more recent additions. The major change was our investment in Liberty Media, which was one of our bigger portfolio positions at 7%. That's now split out into 3 separate stocks. So the main reason we invested in Liberty Media was for what we thought was the prize asset was the stake in Sirius XM, which we've explained in quite a lot of detail in the past. This is the digital satellite radio service that you can pick up in your car in the States, so for about $15 a month. You can choose AM or FM, or you can tune into ad-free Sirius XM, where you get access to lots of unique content, whether it's sports, Howard Stern, and a lot of other music people. And so that actually stock hasn't done a lot for us so far, even though the fundamentals of the business have actually been going really, really well. So we're very comfortable with that. Sirius, of our 7% position, Sirius made up 5% of that, and it was 1% each that got split out into what is now the new Liberty Media and the Liberty Braves. We sold the Liberty Braves fairly quickly. We didn't have any interest in owning that. And the Liberty Media, the other 1% we had in the new Liberty Media, was sold more recently. The main asset in there is Live Nation, and we just didn't think it was particularly undervalued, so we sold it. So we still have the Liberty Sirius XM stock. That's one of the major changes. So one of the more recent additions was Liberty Broadband. We might talk about the Liberty stocks later on because we own a few now, four in total, and we might talk about the difference in terms of the assets, the businesses, and the geography. So, but I just want to pick on Liberty Broadband here that we bought in the middle of February. The investment case here, it was quite a complicated business, but the investment case was fairly simple. I don't know if anyone's listened to Howard Marks, who wrote a wonderful book called The Most Important Thing, where you can read his letters on the Oakmark website. He talks about second level thinking, and there's been a lot of talk over the last year about cable cutting in the US, or skinny bundles, where people no longer want to pay over $100 for their cable subscription and are instead either going to Netflix or like a Stan equivalent here in Australia. And what that's been doing is people have been leaving cable, and so the investment view has been that subscribers down, prices down, bad for cable companies. But when we did the work on Liberty Broadband, we actually found something much different to what the market view was. Now, Liberty Broadband is somewhat complicated in that it's really just a holding company, and its biggest asset was a stake in Charter Communications, and it has now received regulatory clearance to take over Time Warner Cable and to become the second largest cable company in the US. Charter, the new Charter, will be run by a guy called Tom Rutledge, who is widely regarded as the best operator in the industry. So we expect him to cut costs and really push those assets at Time Warner much harder and start pushing any pricing power on content providers with the new much bigger business or combined business. And so that's one part of the story. The other part of the story, though, which is much more interesting, and I should say, sorry, that Charter's actually been increasing its cable subscribers ever so slightly, and it's actually been the satellite providers in particular that have really been losing subscribers. So it wasn't the subscribers were just moving on from every provider out there. It was actually just some providers aren't able to offer a triple bundle like Charter can. So Charter can offer you your broadband, your cable, and your phone, and the churn rate, or the amount of people that cancel their subscriptions each year, is much less for those triple bundles than what it is if you just got one service like cable. So on the broadband side of things with Liberty, it just turned out by stroke of luck that the cable infrastructure that was used for television that was installed all those decades ago actually turned out to be the best way to deliver broadband to the household in the US. So these are very monopoly businesses, because it just doesn't make sense for someone else to come in and build the same infrastructure. And so the example of the second level thinking here is that, okay, it was bad for Charter and by virtue of Liberty Broadband that maybe people might cancel their cable subscription over time. But if you think through that, what are they actually doing instead? Well, they're actually taking up broadband, because if you're going to watch Stan or Netflix, you want the best quality, fastest broadband you can get to make sure you have an excellent TV-like experience. So our expectations are that the pricing or the average revenue per subscriber is going to increase from about $46 to $60 in the US over the next 5 years, and penetration rates for broadband will increase as well. So this was, in a sense, the hidden story within Liberty Broadband, but we didn't actually have to wait very long for people to recognise what was going on. We bought it, which is something very rare for us. We bottom-ticked the stock in the middle of February, and it went up virtually by 50% within a couple of months. So this is now becoming a much more well-known story. And even though we've had good share price gains so far in a fairly short period of time, we still expect there's more to come, and there is actually a chance that we're undercooking the amount of value in the new combined entity that is Charter and Time Warner Cable. We've noted a lot of analyst estimates going up as they start to realise the potential for the combined business over the next 5 years. And the other company we bought around a little bit later, I think it was only 3 or 4 weeks later, and it's a very similar idea, but the geography is very different. So we don't generally buy stocks directly in Latin American or developing markets. It's very hard to find the sort of great quality businesses with long-term track records that we feel comfortable putting large amounts of capital to work in. And it's also important, remember, it doesn't matter how much growth you get out of a company in a developing country. What really matters is that that growth actually comes back to you either by management making smart investment decisions to increase the value of the franchise, or maybe they're buying back shares at appropriate prices, or maybe it's through the dividend. But if you've got a manager who's just trying to enrich themselves or just grow the business for the sake of it, then it doesn't really matter how fast the business is growing, you're just not going to see the result. So this was a very different situation for us. Same principle as Liberty Broadband, except it's about 5 or 6 years behind. So the penetration rates are quite low for broadband in most of these countries. They're around, on average, around 20% versus anywhere from 40 or 50% or above in the Western world. So we've got all that growth to come. And you can see in the chart there some of the main areas, the Caribbean, Chile and Panama. Probably some nice places to take a holiday. We haven't done a research trip there yet. But the most important thing for us is that we still have the Liberty or Western management running this business. So we've got the right assets in the right places, but most importantly, we've got the right management who we trust to take care of the business and make sure investments get made when they need to. And then the modus operandi for the Liberty companies generally is that they'll buy back shares when they have no use for the cash. Very quick update on the banks. Over time, we've reduced our stakes in Bank of America and Wells Fargo. They're about 2% each at the moment, and we've increased our stake in Lloyds Banking Group. Lloyds is a different story. I'd say actually Lloyds is a bit like Wells Fargo in that it's a very clean bank. It's not like Royal Bank of Scotland, which we also have a small holding in, which has got a big clean-up operation ahead of it. Lloyds is very clean. The one problem it's had is it's taken about £15 billion of provisions for payment protection insurance, which was missold prior to the GFC. Now, we don't know what the final tally is going to be, but we are somewhere near the end of that now. The government's talking about giving people 2 more years to put in their claims, and after that, that's it. And what we should see over the next year or two is a massive increase in the dividend for Lloyds. So it was a stock that was around 62 or 63p last week as people were fearing Brexit, and that actually put the company on about an 8% forecast yield. And so you can see there's a huge margin of safety if we do happen to get a Brexit, or maybe there's a recession in the UK or just other bad news. There's a big margin for earnings to fall, and we're still going to own what is the most valuable banking franchise in the UK. It's a very similar banking market in the UK to Australia, so it's a bit like owning Commonwealth Bank here in Australia. It's the best operator, the lowest cost, has the best return on equity, and even though we don't expect earnings to go up dramatically, we expect the dividend to go up dramatically, and when it does, we expect capital gains, because in a zero interest rate environment, we certainly don't expect to see the bank sitting there trading on an 8% dividend yield for very long. Mark, I might hand it to you. Is there any particular stocks you want to highlight?
Yeah, look, actually, maybe just to finish off on the banks, actually, Nathan, just from a risk management perspective, really highlights the focus that we have on total exposure in the portfolio, our risk management. We particularly like Lloyd's. We've added to that position. We do have 4 banks in total. Our total exposure is a little over 10% of the portfolio. But as we added to Lloyd's, we've pulled back slightly on Bank of America and Wells Fargo. So, taking a broad risk management view there in the portfolio. And this really just highlights the top 10 stocks. Happy to take any questions, really. We've spoken to a few of these.
I'll just mention AIG. We've owned it. It's been a long-term holding for us. We're at the stage now where Carl Icahn, hopefully many of you have heard of, a raider in the old days, an activist these days. He's been investing in the stock for, I think, about 5 or 6 months now. He agitated to get a board on the seat, not him directly, but one of his underlings. They've been on the board for 2 or 3 months now, and just recently Icahn increased his stake in AIG. His belief is that AIG should be separated into 3 separate businesses, and management has argued oppositely, saying capital is cheaper for the business if they all remain together, and that if they separate, then they'll have to increase the amount of capital for each individual business, which will be costly. So we don't know how this is going to work out, but it feels like we're getting somewhere near to at least finding out how much value there is. There's about $75 of value on the balance sheet. It trades for about 55. So there's a big margin there, but whether this is going to be a permanently low return on equity business, or whether more can be done, whether it's splitting up the businesses or just management can do better, or the current CEO can be replaced with someone else who can do a better job, I think we're going to find out over the next 6 to 9 months. So we're running out of time. So we had the North American trip, which took in the Fairfax annual meeting. We also went to the Markel Day, 2 hours with Tom Gaynor, which was after the Berkshire meeting. Went to the Berkshire meeting, and we met with those 5 companies there. Mainly, I don't know whether you want to pick on one, Mike, before we take questions.
Yeah, look, I'll just make a broad comment, I guess, in terms of key takeaways from the trip, and with seeing these companies and these people. It really just reinforces the benefit of focusing on quality, and that time is your friend if you own quality assets. So just to really be in good businesses with good management, if you own those at sensible prices and you have a reasonably diverse portfolio of them, you've got a very high chance of doing well over time. Other key takeaways, I guess, as well, in a very low interest rate environment, we're having conversations about our valuation framework. We have a very strict value framework. We've got a fairly high hurdle that we're looking to earn on investment, and in an environment where asset prices are typically very overvalued, does one need to be thinking about making a slight adjustment to one's framework? And our sense is stick to your discipline, stay focused on value. There will be opportunities at some stage, but similarly, if you have a really high quality company that ticks your boxes and you're fairly close on pricing, and maybe there's an argument there to be moving that slightly. And there was some of that was talked about at the Berkshire Hathaway meeting, and in terms of the prices that they're paying for acquisitions now being perhaps slightly higher than what they would have in a much higher interest rate environment.
I might just give a very quick one-liner on each of those companies. So Wells Fargo, just an amazing culture. It was probably the best meeting we had out of a lot. Ended up going for nearly a couple of hours. Guy was very generous with his time. We talked a lot about specific things in terms of its oil exposure, but really just what we got the sense for is just the wonderful culture at that bank. So we're very comfortable with that bank, and if the price goes down significantly over time, then certainly we'd be happy to add to that. We did a tour of the Fremont production facility for Tesla. A lot of robots in there. Actually made us more interested in the robotics companies. There's a company Fanuc in Japan, which we'd like to own at the right price. It worries me about buying those capital goods providers at anywhere near the top of the cycle, because they're wonderful businesses in the recovery period, but when those orders stop during a recession, they look pretty awful, but it gives you a wonderful opportunity to buy cheaply. So we don't own Fanuc. There's another big transaction in that market. But for Tesla in particular, I can't imagine we're ever going to own that business, and we also wondered whether this company's going to have to raise a lot of money, and whether they're actually going to be able to meet their production goals given the size of their current facility. Square is really, it's almost like a Apple product. It certainly looks like one, and we know that because of the guy, Jack Dorsey, who runs Square. It's Jack Dorsey, I think. Anyway, he's always looked up to Apple, and the actual Square product, if you have a look on the website, it's basically the new version of a cash register, and it just looks pretty funky in that sort of white deco and smart, nice, smooth-looking Apple-like way. So they've actually done very well in solving what PayPal solved a long time ago, which is the problem with fraud. That's actually the secret sauce behind PayPal. And what's made it such a great company is that it actually manages to conduct millions of transactions, but it knows which ones are genuine and which ones are fraud. And Square seems to be doing very well at that. But again, unless Square actually started to produce a lot more money, then the market doesn't seem to be that big for the business as it does for other technology companies. So I'm not sure that's one we'd ever own. Markel, again, wonderful company, and we'd love to reintroduce that to the portfolio at a much cheaper price. And one quick takeaway from Adobe was that it had a large, well-known activist in Adobe at one point called ValueAct, who's also in Rolls-Royce, which we also own. And it was interesting, ValueAct has got a lot of credit for the huge turnaround in the Adobe business, where it went from selling subscriptions or licenses to a SaaS model, which is subscription as a service, which has been much more profitable for the business because customers have to upgrade and pay the amount every year. And it was actually interesting, the guy said there just how little impact they really had, despite ValueAct using this as their main marketing tool to attract funds under management. And the guys at Adobe said they already had the plan in place well before they got there. So that's an interesting takeaway. Speaking of takeaways, so just to reiterate the bigger picture, we really need to make volatility our friend. We don't see it as something to be feared of. We actually want more of it. More periods like February means we can put more capital to work in great opportunities. We may need to act quicker. What we saw in August last year, in January and February, was the opportunity didn't last very long. So you never know how these things are going to work out, but it just means that we need to have our active watch list, and when we hit those valuations that we're looking for, we shouldn't be mucking around. We should just be making the investments. And we remain unhedged given the risk to the Australian economy. And although Australia is still a bit of a yield play for the world, and maybe the Aussie dollar rises in the short term, that's quite feasible or plausible. But for us, we're trying to look to the medium and long term, and the currency at the moment is in the middle ground based on historical averages. So we're more than happy to be unhedged at the moment. So with that, we're happy to take any questions anyone has.
Mm-hmm. So we've got a question here on PayPal. Someone's read the article on PayPal. I assume that we've produced. Tech stocks are very hard to value. What aspect of PayPal gives us the confidence that we have a margin of safety when we bought that stock? So we bought eBay, which owned PayPal, in 2014 at around $51 per share for eBay. As I mentioned earlier, at the time, we felt that the market was very focused on poor results from the core marketplaces business and really wasn't focusing on the real value with PayPal as a major unit of eBay. PayPal had started out very small for eBay, but had grown to become most of the company. There was an activist investor who ultimately helped, I think, lead to that stock being spun out. We've held on to our PayPal stock and we've sold the eBay position. PayPal is an interesting company for us because it's one where there is some option value to the company. So this is a company that has a very strong first mover position in the marketplace. We've got a very, very large base of users in a very, very high growth space. So there's certainly long-term risk, taking a 10-year plus view as to what that environment may look like and what the players will be in that space. But we believe there's more upside risk to where PayPal will be positioned down the track than downside risk. So we factor that in. But it's certainly one of these companies where there is a big range of potential outcomes. This could do phenomenally well. It could do relatively poorly for us, and that then feeds into our position sizing. And in the portfolio, any position will be a function of its current price relative to our assessment of value and our conviction level in that valuation. But a key part of that will be the range of potential outcomes. And if there's a big range of outcomes that comprise that valuation, then all things equal, the position will be smaller, and that's certainly the case for PayPal.
There's a lot of money chasing this payment space because everyone knows how profitable it is. If you only go to have a look at the profits of Visa and MasterCard and American Express. But the more I read about it, the more convinced I am that a lot of that money is going to be for not much. It's very hard to move these guys out of the way. It's taken PayPal a long time to get where they've got to, and just because you have a lot of money and an interesting idea and access to good engineers and technology doesn't necessarily you're going to be able to knock these incumbents out of the way. So, obviously if PayPal didn't have the technology aspect to it, maybe it would be a 5 or 6% position rather than the 2 or 3% position it is. But the more I read about the space, the more I feel comfortable that it's going to be very hard to chase and knock PayPal out of the way.
Thanks, Nathan. We're being asked our views on low interest rates, the impact on our bank holdings from low interest rates, net interest margins, and more broadly the discount rate that we're using in our valuations, which I guess I touched on a little earlier. We've not changed our discount rates. That's certainly a topic of conversation inside the company. If you look through history, there have certainly been periods where there have been very low interest rates. I think the 1960s, there were very low interest rates, quite similar to what we have today, and you had quite historically normal equity valuations. So we had a very unique period the last few years where we feel the most marginal investor has been teased into risk assets. There's a huge flow of capital going into markets generally. There's really nowhere to hide in terms of broad asset categories. What we think you can hide in a portfolio of hand-selected great businesses that happen to, for one reason or another, be trading at very attractive prices, notwithstanding the broad environment. But in terms of general asset classes around the world, this is a very, very dangerous time, we believe. So we've not changed our approach to our discount rates. It's a subject that we talk about over time. Maybe, Nathan, in terms of bank margins, speak to that.
Sure. So if I just pick on Bank of America, for example, that business is about, I think, $14 today. Book value, tangible book value is about 18 or 19, and book value is about 22. So that shows you how low the expectations are for that bank already. Lloyd's, I gave the example of earlier, it's potentially trading on, or was, about 7 or 8% forecast dividend yield at the moment. Now I don't think, our base view is that the US and the UK are not going to go into the negative interest rate world. Obviously, that's not going to be good news if they do. But there's just everyone's aware of this risk, and our belief is it's already been more than factored into those valuations. Generally, if it's something that the market is well aware of, it's generally factored into the price. And at the moment, you can afford for the net interest margins at Lloyd's to fall a long way, or at least a decent amount, and still do just fine over time. And actually, more recently, the net interest margin for Lloyd's has been going up rather than down. And for RBS, it's a real fix-up story. So there's actually a hell of a lot of value in that business if they can bring it out over the next couple of years. And it's trading at such a low valuation that even if net interest margins went down, it certainly doesn't destroy the investment case.
Thank you, Nathan. I've got one last question here on platinum, and Ken Nielsen. Sorry, so the question is, Ken Nielsen talks about the Asian century. Do we have any interest in Asia, or do we play US or UK companies that have exposure in Asia? One comment on that more broadly. When you're running a lot of money, I think you really need to be very mindful about those broad macro exposures, and you run very diverse portfolios in all parts of the world. We run a concentrated, hand-selected portfolio of companies. We're very mindful of our exposures to different parts of the world, but we're really focused on a stock-by-stock basis in the portfolio. Certainly, though, we have a position in Rolls-Royce, which manufactures jet engines. They're well placed, we believe, for the Asian century, and will do very well from the growth in consumption in Asia. But otherwise, yes, we're certainly mindful of exposure through our companies, but the focus is in the other major markets.
Yeah, we've done a lot of work on some companies. JD.com, which is in a sense one of the Amazons of China, hasn't been performing very well lately. It's a company we've had a look at. And there's other companies I've looked at from time to time, like a Baidu, which is the Google of China. Now, obviously, Asia is a bit more like Europe than it is the US, in the sense there's a wide range of different geographies there. But so far, we just haven't got comfortable with them. We still have fears about China in particular, and if they were to devalue, we think that would be a big negative for the area, particularly the other export-orientated countries. We've had a look at a couple of companies in Japan. I mentioned Fanuc earlier. That's a Japanese-listed company. There's some good businesses there. There's Shimano, which makes bike components. It's a great little business. So we haven't made a lot of investments there yet. They just don't seem to always tick all the boxes that we need. But we're certainly aware of it, and it would be nice to have some investments there. But for us, it doesn't really matter where the investments are, as long as we're comfortable with the management and the valuations we've got.
Thank you, Nathan. And thanks, everyone, for your questions. We also have Alex Haynes, our Head of Distribution, have a few comments for us.
Thanks, Michael. Just a couple of quick points. There's two main ways you can invest with Peters McGregor, either via the Peters McGregor Global Fund. It's on multiple platforms, or you can invest directly in it, or via our managed account service. I'm very happy to chat offline with anyone interested in either of those ways to invest. We're quite excited this month. We also have announced that we've launched a regular investment plan via our pooled trust. That's come off the back of receiving some very good feedback from our client base demanding that service. This facility, we believe, is a great way for investors to invest regularly in regular intervals into some of the great companies we've been talking about today, and help assist in clients compounding their wealth in a regular fashion. Again, if anyone's interested in our regular savings plan or anything else I've very briefly mentioned, my contact details are on the screen. So with that, I'd just like to thank everyone for joining us for the Peters McGregor webinar today, and we will now close. Thank you.
Thanks.